Okay, so here's a few more ratios, like we haven't done enough already. These are some turnover ratios. So accounts receivable turnover. And basically you're taking net credit sales, okay, and that'll usually be given to you, and then you're dividing it by average net accounts receivable. So that would be accounts receivable less allowance for doubtful accounts gives you your net accounts receivable. You take the beginning plus the end, divide by 2, and there's your average. So you end up with 17.27 times accounts receivable ratio. Well, is that, or accounts receivable turnover ratio? Is that good? Well, I don't know. Sometimes it's, you might ask, well, would it be better if it were 20? Would it be better if it were 10? And so intuitively you want to think, well, gee, what are we talking about here? We're talking about, on average, how many times we're collecting our receivables during the accounting period. And so would you rather be collecting them faster or slower? One way to help sort of have this make more sense is to also do what's called the collection period in days. And this is where you take the 365 days in the year, divide it by the accounts receivable turnover ratio. And so you will get sort of on average, let's see, collection period in days, it would be about 21 days. Okay, so on average, we're collecting our receivables every 21 days. Okay, so let's try a couple of things here. So if we went 365 and we had an accounts receivable turnover ratio of 10 instead of 17, would we be happier or sadder? Well, we'd be collecting on average our receivables every 36 days instead of every 21 days. Oh, I think we'd probably be a little bit sadder in that case. Yeah, we wouldn't be as happy. Okay, what if we did 365 divided by 20? Say we had a ratio that was a little bit higher. Well, then we would be about 18.25 days instead of 21 days. So that's a little better. So we'd probably be happier if it were a little bit higher. So this is one way to just help you sort of understand and make these have a little bit more meaning to you, and they make them much more useful to you if you are running a business or you're having to manage a business and someone wants to know how are things going. Okay, inventory turnover. This is another times type measure, and we're just taking cost of goods sold and dividing by the average inventory. So here's our cost of goods sold, which will usually be given. Here's our average inventory, beginning plus ending, add them up, divide by 2, and we get 8.14 times. And again, we say, are we happy or sad? Would it be better to have this be higher or lower? Well, I don't know. So let's do days in inventory. On average, how long are we holding our goods in inventory? And so if you go 365 divided by 8.14, I think you get about 44.8 days. So on average, we're holding stuff in inventory about 44 days before we sell it. All right, so let's play with this one a little bit. Here's 365. We'll go time, if say we had a turnover ratio of 10, well, 36.5 days. Oh, that might be a little bit better. We're not holding the stuff in inventory quite as long. So let's try it if it were lower. Say we had 5. If we divide by 5, what do we get? That would be 73 days. Now, would that be a good idea? Whoops. Probably not. If we're holding it a lot longer in inventory, we'd probably be pretty sad there. And if we're selling it faster or holding it less, we'd probably be happy. So, anyway, what I'm trying to get across here is just don't memorize the formulas or memorize how to work with them. See if you can make them make some sense to you at this point. Okay, the times interest earned, that's fairly straightforward. It's the net income plus interest expense plus income tax expense divided by interest expense. the most common mistake students make on that one is to use interest revenue instead of interest expense, you know. So you just have to follow the formula there, and it's basically telling you on average, you know, how much do you have available to cover the interest costs. Your asset turnover, this is your net sales relating to average total assets. It's how much, you know, how many sales are we generating for each dollar of assets. This is one where you can compare one company to another and say, you know, given the same amount of assets, you know, which company is generating more income out of them. You know, you can sort of see if you can figure out a way for these to make sense to you. Debt to total assets ratio, it's a very simple ratio to compute, but it's probably one of the most important ones to be aware of if you're thinking of investing in a company or working for a company. So this is your total liability, so it's your current plus your long-term liabilities, and your total assets, okay? And so obviously if you've got your total, make a little room here. So you're going, you know, your total debt and total assets. Obviously, if you've got, you know, total debt of 100 and you've got total assets of 200, so you would have, you know, 0.5. That's probably not so bad. But what if it were, you had total debt of 200 and total assets of 100, okay? And you've got 2. So if you sort of put these into, you know, simple, you know, calculations so that they start to make sense to you. A lot of companies that can be showing good net income may have a rather terrible total debt to total assets ratio, and what that means is that they're paying interest, they're paying on all that debt, and that gives them less financial flexibility. And you can take this in personal terms. If you have, you know, if you owe too much on car loans, mortgage payments, and all of that, compared to your total assets, if you've got to make all these payments on a lot of debt, you have less financial flexibility to go on a vacation or to, you know, do other fun things. So it's the same with companies. So try to take these personally and try to have them make sense to you. And if you have questions, let me know.